Okay, welcome. And today I want to talk about this one paper that I found from 2 Sigma that is called What is ESG? And depends on whom you ask. And basically the three authors look at excess returns by ESG themed indices. Basically they're looking at the MSCI USA ESG leaders and the SRI index. They're looking at the S&P 500 ESG index, and what they're doing is they deducting the non-ESG themed index returns from this ESG themed index or indices. And what they're getting is as they say, the ESG excess returns, which are to be driven solely by the ESG factor or the ESG factors. And what they're looking at the end is at the excess returns correlation, and they find that interestingly the correlation between the different index providers are not particularly high or even negative. Here we have the correlation between the MSCI USA ESG excess return and the S&P 500 ESG. We have a negative 0.1 correlation of the two. And also the rest of them are pretty low. And of course, this is an indication that there's not one ESG excess return that you can harvest by investing in any of these ESG indices, but there's a lot of ambiguity between the different index providers. They compare this to other traditional factors that are known to deliver excess returns, to value and to momentum. And here, in case of value, even though MSCI has a different approach to calculating value than, say, S&P 500, Standard & Poor's or Russell 1000, the correlations of the excess returns, always the excess returns, are still pretty high. Same goes for momentum. So really the question is, why do we see high correlations for other factors, but not for the ESG factor? And basically the paper goes on and explain and give three reasons. First, they say that ESG are basically not standardized in their definition. Different providers or different providers of the ESG scores or indices might have different approaches, might have different data sources, which leads to different selections of underlying stocks to be in their index. And the second reason is that the providers might weight the three factors. Basically, we have ESG, environment, social and governance, differently. One might have a equal weighting of 1/3 each. One might weight more on the environment side or on the government side. And basically this might lead to differences in what stocks are going to be picked. And the third explanation that they're giving is that ESG is basically a muddy concept in a way that, as said, there are three different factors put together. It's like a multi-factor approach, say, including value, momentum, and quality. Or often we see, I guess, value and small cap size factor put together. So it's more like a multi-factor portfolio, and they underlie this finding or this thought by looking at multi-factor returns following. And also they say that at the end the conclusion of there is that ESG should, in their opinion, not be grouped together as one single factor, but should be looked at three different factors, in which case they believe that we would find a higher correlation, even though there's different providers or different companies calculating the scores. So they used the index returns, and I was based on these findings. I was looking at my own approach, which is looking at ETFs. I was looking at the S&P 500 ESG ETF. I was looking at, and there's other US equity from another provider, ESG. And we're looking at some emerging markets ESG leaders, always by different providers, and also EAFE, Europe, Far East. And what I'm finding is basically a similar. So we have here the USA excess returns. We have, again, interestingly, and these are monthly returns, and it's a short time period that we're looking at. We're only looking at 12 months, but even though we see negative correlation, interestingly, between this one and iShares ESG Aware, we even see different between the S&P 500 and the ESG Aware USA, and there's also some that have a bit higher correlation between the MSCI USA ESG Select and I believe this is also MSCI USA, but ESG Aware. So still, but then there are considerably like different correlations, which is interesting, or goes in line of what authors from the previously mentioned papers found. And it's not like they're providing a completely different return path. So these are the simple absolute returns. So no deducting of the benchmark, and we have very high correlation no matter in what you invest. So it doesn't really matter if you invest in the S&P 500 or in MSCI USA. You get very high correlation. But as we've seen, the excess returns over the benchmark are low. And yeah, I'm doing this for different markets. Here the same picture, even though the correlation very high. We're doing this for the emerging markets. We have 3 different ETFs for emerging markets. Again, we have high correlation in one instance between the Nuveen ESG emerging markets and the MSCI emerging markets ESG leaders. But the rest here, again, we have pretty low correlation, even though, again, the correlation of absolute returns are very high. So one idea that I had is that how do you say that it might be beta driven, and that there is correlation between the between the different ETFs. To say if we have a high beta in the ESG Aware or ESG general ESG ETFs, that they might go up together and have high correlation, even though they're not really correlated in the excess returns, simply because they have high market beta. I find that this is not the case. I calculate here the rolling 12 months beta over their benchmark, and we see that they're still, even though like they're the ESG products, but they still have betas around 1 or very much around 1. So we have here the monthly returns, the absolute monthly returns of the ESG ETFs, and we see we don't have really a clear picture. So I guess that's it. If you're interested, please find the original paper from 2 Sigma in the below this video. You find the link. You also find the link to my code, how I calculated these things. If you're interested, Thanks for following, and see you next time.